This video is going to look at the accounting for short-term notes payable. Notes payable that have to be paid off within the next year or current operating cycle are classified as current liabilities. Here's an example. August 1st, ABC asked their supplier, Supplies Incorporated, to accept a 90-day 12% note to replace its existing $5,000 account payable. ABC has an account payable of $5,000 to Supplies. Because ABC is not properly prepared to pay that account payable when it becomes due, they have offered their supplier a 90-day 12% note. In other words, a promissory note stating they will pay 12% interest on the $5,000 liability, plus the $5,000 liability. All will be paid in 90 days. Supplies accepted the note, so ABC would make this entry to record the account payable being paid off, decreasing the accounts payable with a debit of $5,000, and replacing it with a new liability, a credit to notes payable for $5,000. Please note that no interest expense has been incurred on August 1st. Because interest does not start to accrue, or it does not start to accumulate until the day after the note is issued. So on August 1st, no interest expense needs to be recorded by ABC. 90 days later, when ABC pays the note payable plus the interest to Supplies, the amount that they have to pay is they are paying off the liability, the note payable of $5,000. So they're debiting their liability to decrease it. But they're not only paying $5,000, they're also paying an additional $150, which is the amount of the note times the stated interest rate times the fraction of the year. Recall that this is an annual interest rate. So if we stopped calculating at $5,000 times 12%, we would have calculated an entire year's worth of interest. ABC is only paying interest for 90 days of that year. So we multiply that annual interest by the fraction of the year. 90 divided by 360 days, which is a banker's year, or 3/12. $150 of interest has to be paid in addition to the liability. So the total cash that is credited is $5,150. The $150 is recorded as a cost or an interest expense by ABC. A very similar situation arises when a company borrows money. Assume that on September 1st, ABC borrows $20,000 from American Bank. The note payable bears interest at 6% per year. Principal and interest are due in 90 days, which is November 30th. On September 1st, ABC would receive cash of $20,000 and credit the liability for $20,000. Again, no interest expense is recorded because none has yet been incurred. On November 30th, when the note and interest is paid back to the bank, ABC would make the following entry. They would debit notes payable for $20,000, decreasing the liability because it is being paid off. They would credit cash for $20,000 plus an additional $300 in interest, which is the face amount of the note times the stated interest rate. Take that annual interest and multiply by the fraction of the year, 90 out of 360, or 3/12 of a year, $300. $300 is recorded as an interest expense. There are times when a note does not get issued and paid off all within 1 year. Because that note is not paid off within one accounting period, an adjusting entry is required to record the interest expense incurred to date at the end of the current accounting period. For example, if ABC borrowed $8,000 on December 16th by signing a 12% 60-day note payable, the note will not mature, will not need to be paid until the next accounting year, February 14th of 2020. So the note is incurred on December 16th. Between December 17th and December 31st, the company has started to accrue or owe interest, but that interest will not be paid until February 14th of 2020, the maturity date. On December 16th, when the note is incurred, the company would debit cash and credit notes payable. Then at the end of 2019, when they're preparing end of period adjustments, they would need to record an adjusting entry to accrue the interest incurred between December 17th and December 31st. To calculate the interest, take the $8,000 face amount of the note times the stated interest rate of 12% times the fraction of the year, 15 days out of 360 days. The 15 days is the 31 days in December minus the date it is issued, December 16th. 31 minus 16 means 15 days have passed on that note. So they need to accrue 15 days worth of interest, or $40. So they're going to debit interest expense to record December's expense during December and credit a liability, interest payable for $40. So the following year, when the note and interest is actually paid, they would decrease notes payable by $8,000. They're paying off the liability from last year. They also need to pay off last year's interest, so they're paying off the interest payable from last year. They also need to pay the interest incurred from January 1st through February 14th, which is 45 days. Face amount of the note times the stated interest rate times the fraction of the year, 45 out of 360 days. They will need to pay an additional $120 for 2020's interest expense. Total cash paid, credited of $8,160.